paper silver market just sent out a distress signal, and the people controlling the scoreboard, they're pretending it's just another Tuesday. Look, I wasn't even planning to make this video today. I was doing something completely different, minding my own business. And then I saw what happened again, and honestly, it frustrated me. Because the story most people are getting is the comfortable story, the nothing to see here story. But you deserve the full version, the one that actually helps you understand what's coming next. Because while the price gets shoved around on your screen, there's a completely different battle happening. One that involves bars, coins, and actual metal. And that battle, it's about to get very interesting. Welcome to your OG John AG. Now, before we dive deeper into this, do me a favor, would you? Hit that subscribe button. Think of it like locking in your seat at the table where the real conversations happen. You wouldn't walk past a good deal, right? So don't walk past this. And drop a comment telling me, what city are you watching from today? I'm always curious how far these warnings travel. Thursday, February 5th, New York time. And something strange was unfolding in the silver market. Most people didn't notice it because most people were watching the wrong thing. They were watching the number on the screen, the quote, the price ticker. But the real story? It was happening somewhere else entirely. Late that night, a small group of people who follow the metals market closely were having a conversation. No fancy conference room, no dramatic presentation, just a long discussion, longer than it probably should have been, about silver, about the current setup, and about why it felt like they were watching the same movie play over and over again. And here's the weird part. Everybody could see the price getting pushed around. Everybody could see the manipulation happening right in front of their eyes, but most people still couldn't see the real battleground. Because the battleground isn't the number on a screen. The battleground is the bars, the coins, the actual physical metal sitting in vaults and warehouses. And that's where something unusual was building. A kind of energy. A pay-me in metal energy. The kind that doesn't show up in headlines, but changes everything when it finally breaks through. Now, if someone has been watching silver for any length of time, they've seen this pattern before. Silver starts moving up. It begins to breathe. It starts feeling like maybe this time is different. And then, bam, somebody drops a piano on it. Recently, it got dragged down into the mid-80s again, right after flirting with higher levels. Before that, it dipped into the low 70s. And every single time it happens, the same voices come out and say the same thing. See, demand is gone. Nobody wants silver anymore. But here's the part they don't like saying out loud. Here's the part that makes the whole story more interesting. A paper slam, a price drop in the futures and options market can relieve pressure for a minute. It can make things look calm on the surface, while quietly, silently, making the physical problem much worse underneath. And that's the key to understanding what's really happening. Because from recent market updates, from whispers coming out of trading circles, from conversations happening behind closed doors, the chatter isn't about people quitting silver. The chatter is about certain buyers in Asia treating these dips like clearance sales, quietly pulling in serious amounts, serious size, while everyone else is distracted by the falling number on the screen. One of the recurring rumors making the rounds, and it keeps coming up again and again, is that India alone has been scooping up a massive chunk of physical silver, tens of millions of ounces, while the screen price pretends nothing is happening. Now, could that rumor be exaggerated? Of course it could. Markets are always full of tall tales and half-truths, but even if it's only half true, even if the real number is smaller, the direction of the story still matters, because the point isn't the exact number. The point is that physical demand doesn't politely pause just because paper traders had a rough week. The physical market doesn't care about excuses. It doesn't care about narratives. It only cares about one thing, metal changing hands. And here's one more thing about those dips that people miss all the time. When the quote drops, when the paper price falls, a weird split often develops between paper cheap and real world expensive. The screen might say one thing, but the retail premium, the wholesale availability, the actual cost of getting metal in hand, they tell a completely different story. That's not a conspiracy theory. That's just friction. Minting takes time. Refining takes time. Shipping costs money. Financing costs money. And inventory risk. That's real too. All of these factors create a gap. A gap between what the screen says silver costs and what it actually costs to get physical metal delivered to a vault. And right now, that gap is growing, which brings us to the question nobody wants to ask out loud. What happens when that gap gets too wide to ignore? There's a moment in every market cycle that most people sleep through. A moment when the game quietly changes rules, but nobody rings a bell to announce it. And silver just had one of those moments, But instead of making headlines, instead of trending on social media, instead of getting breathless coverage on financial networks, it got buried under the usual noise. Because here's what they don't teach in economics classes. Markets don't always break loudly. Sometimes they crack silently, like ice on a frozen lake, one small fracture at a time, until suddenly the whole surface gives way. And right now, if someone knows where to look, they can see those fractures forming. Let's talk about what actually happened. Not the sanitized version, not the everything is fine version, the version that makes certain people very uncomfortable. When silver dropped into the mid-80s recently, the official story was simple. Weak demand, profit-taking, normal market correction. Standard phrases that sound smart, but say nothing. But here's what the official story conveniently left out. While the paper price was falling, something else was rising. Premiums, wait times, allocation limits, the things that actually matter when someone tries to convert a screen number into real metal sitting in their hand. Dealers started reporting something strange, customers calling in, ready to buy, and being told, "We can take your order, but delivery might be delayed," or "We're limiting quantities per customer right now," or the classic, "Let me check inventory and call you back." These aren't phrases people hear in a market with weak demand. These are phrases people hear when supply is getting tight. And it wasn't just retail buyers noticing. Wholesale players, the ones moving serious volume, were seeing the same thing. Orders taking longer to fill, refineries running hotter than usual, transportation costs creeping up, little signs, individually meaningless, but together painting a very specific picture. Meanwhile, across the ocean, in markets that operate differently than Western exchanges, different rules, different time frames, different priorities, physical metal was moving in serious quantities. Not speculation, not trading, actual delivery. Metal leaving one vault and entering another. And here's where it gets interesting. Because in those markets, the participants don't play the same game as paper traders. They're not looking for a quick flip. They're not chasing momentum. They're building positions, methodically, patiently, the way someone might stockpile food before a long winter. And they're doing it while Western markets are distracted by price volatility. Smart? Absolutely. Opportunistic? Without question. But here's the part that should make everyone pay attention. This isn't the first time this pattern has appeared. Go back through history. Look at other commodity cycles. And the same playbook shows up again and again. Western paper markets focus on price. Eastern physical markets focus on accumulation. And eventually, those two strategies collide. The collision doesn't happen overnight. It builds slowly, pressure mounting, tension increasing, until one day the paper market tries to deliver and realizes the cupboard is emptier than expected. Now, is silver at that point right now? Probably not. Not yet. But the ingredients are mixing. The pieces are moving into position. And the people who've seen this movie before, they're watching very carefully because they know something important. They know that by the time the mainstream financial media figures out what's happening, by the time the headline writers craft their shocking shortage stories, by the time the analysts update their forecasts, the opportunity will already be gone. The metal will already be locked away. The premiums will already be sky high. And the average person will be left wondering, how did I miss this? So here's the real question. The question that matters more than any price prediction or chart pattern. If physical silver is quietly disappearing into strong hands, if the gap between paper price and physical availability keeps growing, if the warning signs are flashing, but nobody's watching, what does that mean for what comes next? There's an old saying in trading circles that doesn't get repeated enough. Price is what you pay. Value is what you get. And right now, those two things are drifting further apart in the silver market than they've been in years. But here's the twist. Most people are celebrating the wrong side of that equation. They see a lower price and think, great, silver's getting cheaper. But what if cheaper on paper actually means more expensive in reality? What if the falling number is hiding a rising cost? Let me explain this differently. Imagine walking into a store and seeing a sign that says, premium steaks, 50% off. Sounds amazing, right? But then someone notices something odd. The line to actually buy those steaks, it's wrapped around the building. And when people finally get to the counter, they're told, limit 2 per customer, and we might run out before you get yours. Suddenly, that discount doesn't feel like such a great deal anymore, because the price might be lower, but the availability reveals the truth. That's exactly what's happening in silver right now. The screen shows one story, but the physical market, the real world, tells another. And the gap between those two stories, it's becoming impossible to ignore. Here's something most people don't realize. The paper silver market futures contracts, options, ETFs, all of it. It operates on a completely different timeline than physical metal. Paper can move instantly. Someone clicks a button, and millions of ounces change hands electronically. No trucks, no vaults, no security, no delays, just numbers shifting on screens. But physical silver? That's a different beast entirely. It has to be mined, refined, transported, stored, insured. Every step takes time, every step costs money, every step adds friction. And that friction? It's increasing. Mining companies are dealing with higher energy costs. Refineries are running at capacity, trying to keep up with demand. Transportation networks are stretched. And insurance companies are getting nervous about moving large quantities of precious metals. All of this creates bottlenecks. Bottlenecks that don't show up in the paper price, but absolutely show up when someone tries to take delivery. And here's where the story gets even more interesting. Because while all this is happening, while the physical market is tightening, the paper market keeps acting like nothing has changed, contracts keep trading, positions keep getting opened and closed, and the underlying assumption, the assumption everything depends on, is that if someone really wants physical delivery, it'll be there. But what if it's not? What if the system has written more claims on silver than there's actually silver available to deliver? And that's not a wild conspiracy theory. That's just math. If 10 people hold contracts for 100 ounces each, but there's only 800 ounces available, then somebody's not getting their metal. And when that realization hits, when the music stops and there aren't enough chairs, that's when price discovery gets very real, very fast. Now, some people might say, but that's never happened before. The system has always worked. And that's partly true. The system has worked because most people don't actually want delivery. Most paper traders are happy to settle in cash. They're playing a different game, a speculation game, a momentum game. But what happens when the mix changes? What happens when more participants start saying, no, I actually want the metal? What happens when Eastern buyers, sovereign wealth funds, central banks, industrial users, all start demanding physical delivery at the same time? The system isn't built for that. The system is built on the assumption that most claims will never be exercised. And that assumption, that critical assumption, it's starting to look shakier by the day. Because here's what the data is quietly showing. Vault inventories aren't growing the way they should be. Delivery requests are higher than normal. And the buffer, the safety margin, the cushion between claims and actual metal, it's getting thinner, not overnight, not dramatically, but steadily, consistently, undeniably. So when someone sees silver drop on their screen and they think, maybe I'll wait for it to go lower, they might be making a very expensive mistake because the price might go lower, but the ability to actually get metal at that price, that's disappearing faster than the numbers suggest. Let's bring this full circle. Because the real story here isn't just about silver, it's about what happens when perception finally catches up with reality. And that moment, that collision, it's closer than most people think. Right now, two completely different narratives are running simultaneously. The paper market narrative says silver is weak, demand is soft, nothing to worry about. The physical market narrative says metal is moving, supplies are tightening, something's brewing. And here's the thing about competing narratives. They can coexist for a while, sometimes for a long while, but eventually, one of them wins. And it's almost never the comfortable one. History is full of these moments, moments when the official story kept repeating, everything is fine, while underneath pressure was building, cracks were forming, and reality was shifting. And then one day, without warning, the narrative flips. Suddenly everyone sees what was obvious all along, and they wonder, how did we miss this? But here's the uncomfortable truth. They didn't miss it. They ignored it. Because acknowledging it would have required action. And action requires courage, conviction, and a willingness to stand apart from the crowd. Most people don't have that. Most people wait for permission from the mainstream, for confirmation from experts, for validation from the masses. And by the time all that arrives, the opportunity is gone. So what does this mean practically? What should someone actually do with this information? Well, that depends on what kind of person they are. Some people will read this, nod along, and do absolutely nothing. They'll wait for more proof, more confirmation, more certainty, and they'll keep waiting until the price has doubled or tripled, and then they'll complain about missing the move. Other people will see the pattern, recognize the setup, and take measured action. Not reckless, not emotional, but deliberate. They'll start building a position, quietly, patiently, treating lower prices as opportunities rather than warnings. They'll focus on physical metal, bars, coins, tangible assets. Not paper promises, not ETFs, not derivatives, because they understand something fundamental. When the music stops, when the game changes, when reality reasserts itself, the people holding actual metal will be in a very different position than the people holding paper claims. And here's what nobody likes to talk about. The physical market doesn't have infinite depth. It's not like buying stocks or bonds where liquidity is virtually endless. There's a finite amount of silver available for immediate delivery, and once that's absorbed, once strong hands lock it away, the next buyer pays a very different price, not because of manipulation, not because of conspiracy, simply because of supply and demand. Basic economics, playing out in real time. So when someone sees these price dips, when they watch silver get slammed down again, they have a choice to make. They can believe the screen, trust the narrative, assume everything is normal, or they can look deeper, question the story, and position themselves accordingly. Because here's the final piece of this puzzle. The people who profit most from market dislocations, they're never the ones who wait for certainty. They're the ones who act while everyone else is still debating. They're the ones who buy when it's uncomfortable, when the headlines are negative, when the crowd is walking away. And then, when the narrative finally flips, when the mainstream media catches up, when prices start reflecting physical reality instead of paper manipulation, those early movers, they're already positioned. They're not chasing, they're not panicking, they're not paying premiums. They're sitting quietly, watching the chaos unfold, knowing they made their move when it mattered. So here's the question worth asking. Not, will silver go up? Not, when will this happen? But rather, what kind of person am I going to be in this moment? The one who waits for permission? Or the one who thinks independently? Because the silver market is sending signals right now. Quiet signals. Easy to miss, easy to dismiss, but signals nonetheless. The paper price is saying one thing, the physical market is saying another. And eventually, one of them will be proven right. The only question is, which side of that outcome will someone be on when it happens?